Hey, welcome back, everybody. Great to have you with me. Don't forget to subscribe to the channel if you haven't already. Like the video, tell your friends and family. I'd like to get to 100 subscribers by the end of October. Give me some help. Tell your friends and family. Click that button. It doesn't take but just a second. Costs you nothing. Thank you. I want to talk about the Federal Reserve, interest rates, inflation, real quick. I'm not going to spend too much time. But one of the reasons that has me on this is the constant drumbeat from the financial news, especially on right-leaning financial news or right-leaning commentators, that interest rates are too high, that the Fed is doing a disservice to the economy, and it's political. He helped Biden. He's not helping Trump. Of course, the Fed cites continuing inflationary pressures and concerns about potential inflationary pressures coming from tariffs. So far, not much has materialized there, and that's good news, of course. But I just want to go through a little bit of data to indicate that interest rates are not too high. Let's just check the federal funds real quick. The federal funds rate, the main tool of monetary policy, the one interest rate the Fed controls to some extent. It's a little less important now than it was 6 or 7 years ago, as the Fed has moved on to paying banks interest on reserve balances and using the overnight reverse repo market to manage the range of the federal funds rate. But if we go back to 1954, the average federal funds effective rate from July 54 to July 25, 4.61%. Put a little 6-month moving average on that, 4.62%. Now that data includes, that average and the moving average includes nearly 11 years where the Fed pegged the federal funds rate below 1% and very close to zero. Zero interest rate policy from 2008 to 2017, and then again from March 2020 to May 2022. A huge mistake by the Fed. Zero interest rate policy and quantitative easing sullied the reputation. But nonetheless, that average number I just cited to you, the 4.61% since 1954, includes those 11 years of essentially zero interest. And so if we had normal monetary policy during that period of time, though it's 11 years in the dates I cited, this number would be higher. So empirically, we consider the past, interest rates are not too high. In fact, one could cite interest rates as being too low when it comes to savers, checking accounts, savings accounts, CDs. Now, of course, we want to relate this to recessions and expansions and contractions. And you can see on the screen, if you're looking at the screen, you can see the gray bars indicate those recessions. But there's no empirical evidence to say that interest rates are too high right now. Just doesn't hold up. Moreover, when you consider inflation data, this week we had the CPI index out on Tuesday and the producer price index out today, Thursday. We still have inflationary pressures and a big pop up in inflationary pressures on the producer side. So on Tuesday, we had the CPI for the month of July. Month over month, it was up 0.2% as expected, against up 0.3% in June. Year over year for July, 2.7% against 2.7% in June, and a touch lower than expected. When we look at the core number, right, excluding food and energy, those volatile sectors, we see month over month July up 0.3% as expected, a touch higher than June. And year over year, we see 3.1% higher than expected and higher than June. So inflationary pressures remain on the consumer level. Remember, the Fed's target for consumer prices is about 2% year over year. Now, I know the Fed's favorite indicator is the GDP deflator from the GDP series, but there's correlations here that we can lean on. And then today we had the PPI, producer price index, out for the month of July, month over month up 0.9%, way higher than expected and way higher than June, which was flat. Year over year, we have 3.3%, well above expectations at 2.5 and above the 2.4 in June. And then again, we look at the core number, excluding food and energy, PPI month over month up 0.9%, well above expectations, well above June. And then year over year, we have 3.7%, again, well above expectations and well above June. So we clearly have inflationary pressures remaining in the economy. And remember, on a year-over-year basis, we're looking for something like 2%, 1.8 to 2, 1.9 to 2.1 as our target, and we're not there. And then if we look at the U3 rate, the headline unemployment rate, the popular measure of unemployment, for July, 4.2%. That's not far off the lows from 1950 of 3.8%. The unemployment rate right now is in the range we call full employment unemployment. The unemployment rate right now indicates that the Fed has satisfied its mandate of maintaining full employment. The inflation data I just spoke about does not reflect that. We have not achieved price stability. And so therefore the Fed should remain on hold. Market expectations, the Fed's going to cut rates in September 25 basis points. It seemed to be priced in. This PPI data may change that a little bit. I'd like the Fed to remain on hold for the balance of the year. Trump is telling us every day how hot the economy is. If the economy is hot, then we don't want to be lowering interest rates. Now, Trump is like any other politician. He wants a robust economy. And one of the ways to help that along is to lower interest rates. When we look at M2 data, the monetary aggregate, M2, right now, M2 is at $22 trillion as of June 2025. In 2019, it was 15.2. In 2008, it was 7.5 trillion. So we have plenty of money in the system, remaining inflationary pressures, full employment, unemployment, a federal funds rate below the long-term moving average. And so clearly, interest rates are not too high. The Fed does not need to cut interest rates. And we should be intellectually consistent, those of us on the right, conservatives, whatever you want to define yourself, to criticize Trump when he's wrong. And he's wrong here, as are all the people that are trying to help him along by pounding on the table, Jerome Powell must cut rates. All right, that's all I have for you right now. Always try to buy American.